If you're a founder of a scaling company and you have this feeling that whenever the conversation turns to finance, things suddenly get complicated, time-consuming, or just foggy, then this episode is for you. My name is Agnieszka Jurczyk. I work with founders in moments of rapid growth, when their company has become too big to keep all the moving parts in their head, and when decisions carry too much weight to be made purely on intuitive gut estimates. In today's episode of Founder to Zero, we'll talk about finance, but not from an accounting or spreadsheet angle, from altitude, from a founder's perspective. I'll talk about why, at a certain scale, the numbers from your books stop being enough, and what to do and in what order so that finance stops being just a painful reporting obligation and actually starts supporting you in making strategic decisions. Let's go, shall we? Raphael very rarely gets this angry. What do you mean 4 months? On the other end of the line, the finance director is trying to explain something, but Raphael seems to not hear him at all. 2 months ago, we were talking about 8 months. 8 minus 2 is 6, not 4. Well, some things have changed, comes the reply. Costs went up. You can't just copy-paste that. Raphael feels that if he doesn't cool down, he won't hear anything useful. Okay, give me a minute, he says, and hangs up. An email from the VC fund's investment analyst is still staring at him from the screen. A response to the files they shared as part of due diligence. You stated 6 months of runway. The model we received suggests no more than 4. Please explain the discrepancy. Below that, more questions, but Raphael doesn't even read them. Their sheer number makes his stomach clench. On one monitor, the Excel file from 2 months ago, sent right after the NDA was signed. On the other, the current one, uploaded to the VDR yesterday. Raphael flicks his eyes from one screen to the other, faster and faster. The formulas check out. The logic looks consistent, only the result is completely different. Raphael opens the latest sales report and clicks into the ARR tab. There, different numbers again. Completely different. He opens the billing module, checks last month's totals. The numbers, different too. His heart is almost in his throat. He hovers his cursor over the link to the BI dashboard, but he doesn't click. He's genuinely afraid of what he'll find there. So he types in the key team chat, "Call in 15 minutes, urgent," and he walks out. If he walks the stairs up and down a few times, maybe he'll cool off. The call starts with no small talk. Everyone has their own numbers, and everyone is absolutely certain of them. The problem is, they are not the same numbers. Raphael finally cuts off the discussion. Stop, let's start from the beginning. Revenue. Sales talks about ARR. After a moment, it turns out the numbers include renewals that haven't actually happened yet. But they will happen, it's just a formality. Finance talks about revenue on an accounting basis. Receivables, adjustments, deferred income, a few other things Raphael doesn't fully understand and definitely doesn't have time to work through right now. Right, he sighs. Costs. Maybe that will be simpler. Nope, it is not simpler. Finance says they took last month and ran the trend because something had to be sent, and Raphael signed off on this. The head of ops reacts immediately. With that budget, we definitely won't deliver. Why did no one consult me on this? Then a dispute breaks out about licenses. Who pays for what? What belongs to whom? A few turned out to be nobodies. Look, if you round the big numbers up, then it all adds up. The head of sales throws in, trying to ease the tension. But nobody laughs. Everyone can see it doesn't add up, not even the rounded numbers. After 2 hours, Raphael knows this isn't going anywhere. Okay, he finally says, everyone start from the scratch. Estimate what you need for next year. Monthly. Net. Sales, add revenue numbers, recurring and non-recurring separately. We'll meet in 2 days and hopefully we'll put it together somehow. The call ends and the budgeting process begins from the scratch. Again. Raphael takes 5 runs at drafting a reply to the investor's email. In the end, he sends a terse, checking, will follow up. And he feels completely exposed. During the pitch, he was a lion. Over a spreadsheet, a trembling kitten who has no idea where it is. Meanwhile, in the key team chat, a literal tsunami. What about the new market we were going to open? Which scenario should I put in the budget? What do I assume for hardware costs? It depends on headcount, and I don't have that figure. HR has a different hiring plan than product. Which assumptions are binding? Are we migrating the infrastructure? Should I include migration costs? Who can give me the volumes? Without those, I can't estimate anything. Raphael stares at his phone screen, completely spent. He was hoping for answers, and all he got are even more questions. And he can't reply to anyone because the answer to all of them is, it depends. But it could be different. Picture the same funding round. Due diligence has been running for a few weeks already. Raphael is pouring himself a coffee when his phone vibrates in his pocket. An email from one of the 3 investors still in the process. A few questions about the budget. Raphael taps the notification and opens the message. Questions about their plan B for 3 external risks and how those would affect runway and path to profitability. Raphael opens the financial model and, sipping his coffee, starts typing his reply. On the new AI regulation, we fall into the minimal risk category because our model isn't used to evaluate individuals. We're not expecting any increase in compliance costs from that, but we do have a 5% general reserve in GA, partly to cover regulatory changes like this one. On potential tariff shifts in the US is currently 5% of our revenue. We're factoring in more pricing pressure on that market. The pessimistic scenario you received already reflects lower US revenue for that reason. Runway is 1 month shorter, break-even is 1 month later. On the potential changes to contractor social contributions, Raphael calls the finance director. Hey, how much would our people costs go up if the new contractor contribution rules come in? The finance director answers immediately. Our fixed-term contractors are already fully covered, so nothing changes there. For freelance project work, we'd need to add roughly 20%. In value terms, project work is, give me a second, just under 6% of our total payroll. So you're looking at around 1.2%. Why are you asking? The investor wants to know, Raphael replies. Okay, round up to plus 125 just to be safe. Before Raphael even makes the changes in the model himself, the finance director does it for him and says, runway unchanged. How about break-even, Raphael asks. 1 month later. I'll send you a copy of the model with that scenario right now, so you don't have to click around. Raphael adds a few lines to the investor email, attaches the file he just received, and hits send. Then he finishes his coffee, closes the laptop and heads out to a meeting regarding a new market they're about to open. A few days later, somewhere between one call and the next, Raphael's phone vibrates again. A message from the VC partner. Thank you for the clarifications. We can consider due diligence complete. We're maintaining the valuation from the term sheet. Offer attached. Raphael reads the message again, slowly. Not because he doesn't believe it, but because for the first time he has the sense that they spoke as equals. He didn't have to pretend to be a lion. And he wasn't a terrified kitten who has no idea where he is either. He was simply a founder who knows exactly how his company works. And that's what we're going to talk about today. What to do to get to that place. Before we go further, a quick ask. If what I'm talking about here resonates with where you are right now and you'd like to hear more, hit subscribe. A thumbs up on this video would also mean a lot. In return, I'll keep making more content about how to scale a business without losing your mind along the way. Thank you for every bit of support. There's a myth that wrecks finance in scaling companies no less often than a missed sales target or costs that got away from you. That myth is the belief that finance equals accounting. That if all your documents reach the finance team on time, VAT is reconciled, and every month you reliably get an email with a balance sheet that balances, a P&L where the result more or less tracks with what you see in the bank, a general ledger in case you need the details, and a tax return paid on time, then finance in your company is sorted. Or that if your accounting data feeds automatically into BI so you can check a live dashboard without asking anyone, then you're really in great shape. Well, not quite. At a very early stage, that is usually enough. But the moment your company starts growing fast, is thinking about international expansion, or enters conversations with funds about the next investment round, when decisions you're making as a founder start running into millions, the assumption that finance equals accounting simply stops working. And not because your accounting isn't well managed, but because accounting, conceptually, is built for a completely different purpose. Its purpose is statutory reporting, regulatory compliance. In short, the financial statements you file with the business registry every year are a template designed for the needs of the state. They're meant to answer the questions of tax inspectors and social security auditors, not yours, and not your investors. And it's not hard to imagine that those aren't the same questions. The government isn't interested in what happens if your sales miss plan and your main supplier raises prices by 10%. The government simply wants to be able to verify, if necessary, that you paid your taxes and contributions correctly. Statutory reporting puts everyone in the same bucket, whether you're a SaaS company, organize tours to Asia, or manufacture lamps. The balance sheet and P&L template is the same. And yet, the devil is in the details. The mechanism that generates profit is different in every company. And the foundation of scaling your business is having a single source of truth about how that mechanism is doing. Whether everything is running as it should, or whether something needs oiling and adjusting. In your company, not in an averaged out picture simplified enough to fit everyone. Statutory reporting can't show you that. What can is management reporting. Management reporting is based on an entirely different philosophy. It doesn't look backward through the eyes of someone who'll be explaining themselves to the tax authority. It does look backward, yes, but from a different angle, to have context for estimating the future in different scenarios, to help you make decisions based on data that's consistent across the whole company, not just locally sensible from individual teams' viewpoints, each of which sees only a fragment of reality. And so that finally, you don't have to deal with that eternal, it depends. If you have the feeling that the finance team in your company lives in its own world and doesn't really understand the business, while day-to-day decisions get made somewhere else entirely, you most likely don't have an accounting problem. You're much more likely to have one of the four very common problems I've encountered not just in scaling startups, but also in large companies with multi-million revenues and hundreds of people on board. Problem one, finance architecture. This is finance designed around statutory reporting because nobody ever defined anything else. In this architecture, management data is just a byproduct of reporting to tax authorities. An ad hoc add-on, not the main point around which the thinking is organized. This is the direct consequence of the assumption that finance equals accounting, and that since everything is in the books anyway, you just need to slice and dice the data the right way, add some details from the CRM, the job management system, and a couple of other sources, and here you have management reporting. No, you don't. What you have is a mess that eats enormous amounts of time and energy. If your chart of accounts starts from statutory reporting structure and doesn't align with either how decisions are actually made or the real accountability structure, meetings end in disputes over numbers, arguments about who's right, and searches for the source of yet another inconsistency. So you try to sculpt what you have, adding whatever you can from wherever you can, moving things from bucket to bucket until it finally looks like it fits. And that takes everyone's time. Your frustrated accounting team feels like they're non-stop doing hundreds of unnecessary journal entries and processing some Excel files that have nothing to do with actual bookkeeping. Your managers don't want to take accountability because KPIs they're measured on are based on costs they had no influence over. And the budget, technically, it exists, but it doesn't answer real questions, so no one actually makes decisions based on it. And you are left hearing, it depends, forever. Problem two, integration, or rather absence of integration. Sales has their numbers, tech has theirs, ops has theirs, finance has yet another set. Each set comes from a different source, and each one is correct. The problem is that none of them fit together, and none of them gives you a complete picture. ARR comes from the sales report, revenue from the books, cash from the bank account, variable costs from the ops job management system. In meetings, everyone defends their own version, and the founder sits in the middle of all this chaos, sensing that something is badly off, but with no idea what exactly. Because it's exactly like trying to assemble a jigsaw puzzle from pieces that come from 10 different boxes. Problem 3. The way you forecast. Data is recorded by accounting in a schema designed for the needs of the state, not the needs of the entrepreneur. So the actual drivers of individual costs and revenues usually aren't visible in that data. Everywhere you look, you hear the same mantra. It depends. So when you need to build a budget, you have no choice but to read the tea leaves. You extrapolate history in a company that's growing too fast for all the relationships to remain linear. You plan costs without linking them to actual drivers. You build one budget scenario because preparing a second one is a week's extra work, and neither you nor your finance team have that extra week. And you quietly hope that the investor won't notice and the world won't change that dramatically. And then, out of nowhere, the actual runway looks nothing like what you were assuming not that long ago. And finally, problem 4. the leadership one. The least intuitive and the most severe in consequences. It's handing the task of organizing finance to the finance director in hope that they will sort everything out for you. You give this person accountability without the real authority to actually deliver. Remember episode 4 on accountability? Or episode 6 on preventing conflict? Accountability without decision authority is nothing but a trap. To make finance a management tool rather than just accounting, it's not enough to build better tools or refine the document flow. First, you need to align what's being reported with the actual accountability and decision authority structure in your company. Your finance director can help you with that, of course, but they can't do all of it for you. Not least because they have no say over where the boundaries lie between who owns what and who can make which calls. The finance director can't decide who owns churn, for example, or whether UX sits under marketing or under product. And those are exactly the kinds of things that most often need sorting out before any order in finance is even possible. Before reporting can actually start supporting scaling instead of slowing it down. Without that, the founder is left with reports that aren't conceptually built for their actual needs, with data that isn't information, let alone knowledge. Stuck in the trenches of micromanagement because they don't have the tools that would let them finally get out. And that's exactly why Finance 2.0 is not about Excel, not about understanding journal entries, and not about implementing an ERP. It's first and foremost about upgrading the way you think about what gets reported, why, and for whom. So let's take a look at how to make that upgrade. Now that we know what makes early-stage startup finance stop being enough at a certain point, it's time to start changing it. Because once your company is large enough that you can't quickly run all the interdependencies in your own working memory, it's worth having them captured in a single place, even in simplified form, so that when one variable changes, you're not adjusting everything else purely on intuition. You can do it based on data. For that, you need a model that connects product, sales, operations, and finance into one coherent whole. And if you want that model not to require months of data processing every time you need to update it, you need consistency between how the data is recorded and how it's used across different parts of your company. Without that, reporting is simply unscalable. That's why Finance 2.0 doesn't start with changes to accounting or even with the budget. It starts with understanding what's causing the main pain around financial planning. The one that keeps coming back like a boomerang every time you ask people for assumptions and hear, "It depends," in response. Yes, it depends. And precisely because it depends, you need to lock something down. Otherwise, "it depends" is just a vicious circle with no way out. If this attempt at financial planning is finally going to generate answers instead of generating just more questions, you need to pick a starting point. And in one of those "it depends" moments, just make an assumption. That's exactly why the first stage of building Finance 2.0 is the goal. The goal your company is working towards. As a whole, one outcome you want or need to achieve. In practice, many companies start with revenue assumptions and define their goal as a revenue figure. I usually start one step earlier, from valuation. The valuation you need to reach for your company to be attractive to investors, both the ones already on board and the ones you're still trying to attract. Because in scaling startups backed by investment funds, where the return on investment depends on what their shares will be worth at exit, it's the target valuation that drives the revenue targets. And it's the target valuation plus your ability to show in the financial model that you know how to get there is what defines how attractive your company is in the eyes of investors. Once you have the goal, it's time for step 2. And no, it's not a spreadsheet, nor is it data in the books. It's structure. When you're about to send your financial model to a potential investor, it's worth looking at the structure from a different angle than usual. Not from the angle of job titles that your people write in their email signatures, and not from the angle of the charts of accounts built by accounting for statutory reporting. It's worth looking at it from the angle of your company's goal, the one you defined in step 1. And then from the angle of the key success factors. What does this outcome actually depend on? What has to happen for you to achieve it? Internally, inside your company, not in the external environment. Who needs to deliver which of those elements? Because that's what determines what those people will need in order to be able to do it. At the most general level, you need 4 things that your company will do well and efficiently. A product that works, a business development function that will attract customers who will buy it, operations that will serve those customers well enough to keep them, and general administration that will make sure your people have the means and the space to work, get paid for it, and that your company meets the regulatory requirements it's subject to. And those 4 elements bring us to step 3, the budget. Because product, business development, operations, and general administration are the 4 core pillars of your budget and management reporting. And we're not talking about budget in the sense of spending limits. A good budget in version 2.0 is not a flat spreadsheet with amounts assigned to months. It has far more power than that. Because this time you're starting from the goal and breaking that vicious cycle of those dozens of "it depends" answers, you can now model all the interdependencies and manage them proactively. And when something changes, find out in advance how it will affect your runway, your valuation, and the return your investors can count on. In effective budgeting, sequence is everything, because that's what lets you avoid hundreds of those "it depends" answers. If valuation is your starting point, then the sequence will most likely look like this. You'll start with revenue targets. You calculate them based on the assumed timing of your next funding rounds and the valuation that you want to reach at each of them. Then, applying simple valuation multiples, benchmarks for which you can find online without much trouble, you get the revenue targets that need to happen for the valuation to land where you're aiming. If you're already at this stage of positive EBITDA, the approach adjusts accordingly. Second step is budgeting your business development costs. Now that you know what revenues you need to hit, you can figure out how much, given your conversion rates, it will take to actually deliver those results. This step should give you not just the revenue figures, but also the number of customers, transaction volumes, the number of markets you'll need to be in, headcount in business development, and a few other elements that feed into the next steps. Knowing your customer numbers and transaction volumes, you can plan costs of operations. How many people you'll need to serve those customers, your technical infrastructure, API costs for external tools, and subcontractor services that form the backbone of what you deliver. In the next step, you can start planning product development. For a first iteration, you can simply assume a fixed percentage of your revenue. There are market benchmarks for that too. General administration is usually planned last, because that's where most of the "it depends" actually lives. For example, HR and IT help desk will directly depend on headcount across other functions. Legal costs will start growing as you expand into other markets, and so on and so forth. In each of the 4 cost pillars, business development, operations, product, and GA, it's important to split costs into 2 categories. OPEX, which is operating expenditures, and CAPEX, which is capital expenditures, purchases of fixed assets or intellectual property rights that will serve your company for more than a year. For example, laptops, office equipment, servers if you need to buy your own rather than use hosted infrastructure. That distinction will be needed for your finance person in later steps. Because it's only now that we reach the part of the budgeting process that finance can do without you. I won't go into details here. I'll just say that this is the moment when, based on the budget, finance prepares your projected P&L, balance sheet, and cash flow, plus analytics like unit economics. You don't need to understand all the mechanics. You don't even need to know how to calculate depreciation or taxes. What you can expect from finance here, however, are a few questions of business nature. For example, about payment terms you want to offer your clients. Especially if your industry typically offers long payment terms, that's something that needs to be reflected in working capital. For the first iteration, just assume something that sounds market standard. As a result of this step, you should receive from your finance team a projected P&L, balance sheet, and cash flow based on the assumptions gathered in your first pass at the budget with your managers. Here, you'll see how much cash you'll need to raise from investors and when. And at the assumed valuation from stage 1, how much dilution you as founder are actually facing. At this moment, you can check whether what you've come up with is actually attractive to investors and to you as a founder. From experience, I'll tell you this. The first pass at the budget usually ends with a fair amount of swearing and tearing your hair out. And that's completely normal. But it gives you something very valuable. Knowledge of what targets your team is actually comfortable with. And this is the moment when you need to have an honest conversation about something that many founders push out of their minds entirely. You see, budgeting surfaces a conflict of interest between 3 parties: founders, investors, and the team. From the team's perspective, the more money you raise from investors, the easier it is to deliver the targets. The less you raise, the higher the risk, and the greater the resistance to taking accountability for the outcome. From the founder's perspective, more money from investors means more dilution and less control over the company. So naturally, you want to aim for the highest possible valuation, which means more ambitious targets the team will have to deliver. From the investor's perspective, the lower the valuation, the better, of course, because it means greater potential for a higher return at exit, whether through the sale to a strategic investor or through an IPO. So everyone pulls in their own direction. Worth keeping in mind as you go through the subsequent budgeting iterations, because it won't end after one. Budgeting isn't a spreadsheet. Budgeting is the art of compromise between the founder's interests, the team's interests, and the investor's interests. It's the moment when, even if you never name it explicitly, you're deciding who actually gets what from your shared venture and who has to absorb how much pressure. A good budget is one where these forces are in balance. One where your team feels they can deliver what you're asking for, even if it's ambitious. Investors feel that the targets aren't from another planet, and the valuation they're looking at will let them earn what they need to earn to satisfy their own investors and keep attracting new ones next time they raise a fund. And you as a founder finally have the sense that you genuinely understand what depends on what. And everyone, regardless of their role, is pulling in the same direction. That's why, despite the common fear, a good budget doesn't constrain. It enables. It enables you to delegate, and it enables your people to take accountability. Because now everyone has the same context. They know their boundaries, they see one shared goal, and they know how you're all planning to get there. And when the situation calls for it, they can see in advance that something needs to change, because if it doesn't, your shared train will simply not reach the station it's supposed to reach. With a good budget, it depends disappears, because everyone knows what they can count on, and everyone knows what they have to deliver so that others can count on them. And that's exactly the moment when you can finally, once and for all, say goodbye to micromanagement. Because now you have control over the company without having to get into every single detail individually. We have the path, step by step. So let's think about how to make sure that budgeting is not a 6-month project, but something that can actually go smoothly. Because Finance to Zero isn't about predicting everything in every detail. It's about capturing the big picture at a level that's good enough. Good enough to anticipate what matters so the company can grow faster, more coherently, and with fewer nasty surprises. An overly detailed budget gets heavy, slow, and ironically, completely useless. I once received a budget from one of my clients' portfolio companies that had over 500 line items. Their head of finance, an accountant, had simply exported detailed ledger data aggregated by vendor and extrapolated historical trends from that aggregated data into the future, line by line. I don't need to tell you that the investors were not really impressed, and that inside the company itself, nobody used it, except the person who made that file. That's why for budgeting, like for almost everything in growing startups, it's worth applying the MVP thinking, meaning identifying only those elements that genuinely have a real impact on the outcome, focusing on modeling the key interdependencies between them, and throwing everything else into a bucket labeled reserve. That is not cutting corners. It's just a conscious decision. We're not breaking this down today because at our current scale, it doesn't yet have a material impact. The reserve is a buffer for uncertainty, and in a growing company, uncertainty is probably the only thing that you can predict with 100% certainty will happen. Only when something in the reserve grows large enough to become material does it make sense to ask whether it's worth tracking it separately. Because the level of detail in a budget grows with the company. It doesn't need to outpace the company. Actually, it really shouldn't. The key question is not, do I have everything calculated? The key question is, do I have a sensible grip on what actually matters at the current stage of my company? At the end, as always, I have a small challenge for you. Not so you build an entire financial model today, just so you can see where you are on this path right now and what your next step is. So open a notebook and answer a few questions honestly. But be honest with yourself. That's probably the most important part of this exercise. And think MVP, only about what matters most. Question 1. Do you have one clearly defined financial goal that your company is heading towards? Not we're growing as fast as we can. Not we want to be the biggest in the market. Not we want to raise money, but without diluting too much. No. It needs to be something you can express as a single number assigned to a single month, before the end of which you want that number to have materialized. Seneca put it well. For a person who doesn't know which port they're heading to, no wind is favorable. So if your goal doesn't yet reduce to one specific number assigned to one specific month, you already know where to start. Question 2. What actually has to happen for your company to reach that goal by the end of the month you've just named? Not every detail, not external factors, just 3 to 6 most important high-level variables that your company has real influence over. If there are too many, they're ambiguous at different levels of specificity or they overlap, that means the model of your business is most likely still forming in your head. And in order for your business to scale to a really significant size, you need to get it out of there. Question 3. Does each of the drivers you listed in question 2 have one owner at the C-1 level? Not we manage it as a team. Not marketing in collaboration with product. One specific person accountable for the driver end to end, and with real authority to decide how they'll deliver it. If those drivers cut across multiple people's accountability areas, or people are responsible for things they have no real influence over, you already know what needs to change. Because even the best budget without clear accountability and decision authority will drift, sooner or later. Question 4. Do the numbers that different teams use describe the same reality? Do they use the same terminology? Do people from these teams understand that terminology the same way? If everyone has their own numbers, their own definitions, and their own sources, especially if those don't align, you don't have a finance problem. You have an architecture problem. And before you go further, that architecture problem needs to be sorted out. And question 5. How does your organizational structure, the one that your HR uses, where everyone knows who they report to, map to the driver structure that came out of question 2? And how do both of these relate to the chart of accounts that your finance team works from? If those aren't one and the same, you know what to do. Align them first, because only with that alignment can your CFO actually start building finance in a way that supports scaling instead of holding it back. Good luck! I'm really curious which question surfaced your first to do. Let me know in the comments. In the next episode of Founder to Zero, we'll tackle the topic that keeps many founders up at night. Conversations with investors. We'll talk about what makes an investor stop looking at a founder as someone who has to justify every decision they make and start looking at them as a genuine partner. We'll look at the startup world through the eyes of an investor. How they think, what drives them, and what constraints they're working within, because understanding the other side's perspective is the first step to running those conversations effectively. And if after today's episode you feel that finance in your company still isn't giving you the certainty you need, that reports stress you more than they support you, or that you want to structure them so they actually help you make strategic decisions faster, let's talk. You'll find the contact link below this video. And if this episode was useful, leave a comment, like, share, subscribe. It genuinely helps me make more content like this. That's it for now. Take care, and see you in the next episode.